Alright, so we all know that trading perpetual futures is oftentimes a rigged game against the average trader, except for when a platform comes along and changes that. Imagine a world where market manipulation, hidden fees and fragmented liquidity pools are replaced by transparency, fairness and efficiency. That's the vision behind Vest, a decentralized platform aiming to revolutionize derivatives trading in the DeFi space. But does it deliver on its promises? Or is it just another ambitious experiment in the blockchain finance space? Hi, I'm Stan and I'm happy to welcome you to another airdrops.com video review of a Web3 protocol that will bring you an easy airdrop. And it is confirmed. Today's topic is Vest. Perpetual futures are one of the most popular financial instruments in both traditional finance and DeFi. They allow traders to speculate on asset prices without owning the underlying asset. However, this market has long been plagued by inefficiencies. In traditional finance, centralized exchanges dominate, often prioritizing their profits over user experience. In DeFi, on the other hand, while some platforms have made strides in decentralizing derivatives trading, they still face issues like fragmented liquidity pools and lack of protection against predatory strategies. Vest tackles these issues head-on with its zero-knowledge proofs, zkPs, and a vertically integrated risk engine. The zkRisk technology uses the zero-knowledge proofs to continuously monitor market conditions, trader positions, and system-wide exposure. In simpler terms, Vest eliminates hidden costs and market manipulation by making pricing fully transparent and fair. This is a significant step forward for traders who have grown weary of unpredictable slippage and front-running tactics that plague both centralized and decentralized platforms. Vest plays it safe by not exposing its users to the maximal extractable value (MEV) phenomena. I won't go into detail, but just keep in mind that if MEV is left unchecked, miners can screw you over big time. For an efficient use of the MEV, however, I encourage you to check out another project I analyzed recently, and that's Monad. I'll post the link in the description below. Also, there's the Monad airdrop that you might be interested in. Back to Vest though. Another core innovation is its single liquidity pool model. Unlike traditional platforms that rely on fragmented pools for each trading pair, Vest consolidates liquidity into one unified pool. It ensures that trades are priced based on real-time risk rather than opaque market maker strategies. This approach not only improves capital efficiency but also reduces the barriers for liquidity providers who no longer need to manage multiple pools or worry about impermanent loss across various pairs. By aligning incentives across traders, LPs, and the protocol itself, Vest aims to deliver a more stable, efficient, and accessible DeFi derivatives market. One very important aspect of Vest is its approach to tokenomics, or rather, its current lack of an official token. Instead of launching a token right out of the gate, Vest has introduced a points-based rewards program for early adopters. Users earn points for trading activity on the platform, which are expected to be convertible into tokens once Vest launches its native cryptocurrency. This strategy not only incentivizes early participation, but also ensures that the eventual token distribution will significantly favor active users, such as traders, liquidity providers, while the team and seed investors would hold a minority stake of the total token supply. This promises decentralization and aligns with platform growth by ensuring no one single party dictates the direction. Looking at Vest's broader potential reveals some exciting possibilities. While its primary focus is on perpetual futures trading today, the platform's underlying technology could be applied to a wide range of on-chain financial products. The zkRisk powered pricing models can be used by institutional traders for illiquid or emerging assets markets that traditional financial systems struggle to handle efficiently. Vest's technology that provides audit confidentiality and high throughput validation also opens doors for multi-chain deployment. However, these opportunities come with challenges. Building deep liquidity is critical for any trading platform to succeed. And while Vest's single liquidity pool model is innovative, it still needs a substantial participation from liquidity providers to achieve meaningful scale. Another hurdle is regulatory uncertainty, of course. As governments worldwide increase scrutiny on DeFi platforms offering derivatives products, Vest will need to navigate complex legal landscapes carefully. Scalability, when it comes to handling major market swings, will also be of dramatic importance. Ultimately, if Vest achieves robust liquidity and continues to refine its risk-centric, no MEV model, it could become a template for how to pull off advanced trading on a decentralized network. Now, this is how you bridge the gaps between DeFi and traditional finance. Or it could be. Let's look at the team behind Vest. Since July 2021, it is led by Justin Ma, whose background as a crypto quant researcher suggests a deep understanding of financial modeling and blockchain technology. Ma's experience spans AI startups and venture analysis, indicating he brings both technical expertise and strategic vision to the project. Some of his past employment history reads names like Carlecki, Berry, Plug and Play Tech Center, UPenn, even the US Senate as an intern. While details about other team members remain limited at this stage, the involvement of high-profile institutional investors like Jane Street and Big Brain Holdings suggests to me that the team's expertise has been vetted to the bone. It's time we turn our attention to another crucial aspect, and that's funding. In March 2025, Vest secured $5 million in seed funding from top-tier investors such as Selene Capital and QCP Capital. Some angel investors from BlackRock and Citadel are also on board. This follows an earlier round of investment and participation in Beacon's accelerator program. All these developments around the capital raising for Vest signal that institutional confidence in the platform is growing steadily. These latest funds will be instrumental for development of Vest's universal risk engine and scaling its infrastructure to support more users and assets. Community engagement is another area where Vest shows promise but still has room to grow. The platform has cultivated an active niche community of DeFi enthusiasts who are excited about its potential innovations in derivatives trading. To be honest, there's not much buzz around Vest, but I take it as a positive. Why? Well, this only suggests to me that it is still in its early adoption phase, and that's exactly the level of development at which we want to become involved with a project. The earlier we are, the larger the airdrop. In terms of competition, Vest operates in one of the most crowded sectors within DeFi. That's decentralized derivatives trading. Established players like DYDX dominate this space with robust order book models and deep liquidity pools. GMX offers an alternative approach with its automated market maker model tailored for perpetual swaps. Meanwhile, newer entrants like Hyperliquid are building custom layer 1 blockchains specifically designed for financial applications. What sets Vest apart from these competitors is its proactive approach to risk management through the zkRisk engine and its single liquidity pool model. By addressing inefficiencies in pricing transparency and capital allocation head-on, Vest carves out a unique position in this competitive landscape. However, competing against well-established platforms with significant user bases will require flawless execution on both technology development and marketing fronts. Vest's strengths lie in its innovative technology stack and institutional backing too. These are two factors that lend credibility to its ambitious goals. The platform's focus on transparent pricing eliminates many pain points that traders face today while setting new standards for fairness in derivatives markets. Its timing also works in its favor, as demand grows for secure yet scalable DeFi platforms, especially after the FTX collapse. Not to mention that the perpetual futures market is worth over $100 billion. That said, risks remain significant. As with any new platform entering an established market segment like derivatives trading, Vest faces an uphill battle, especially when major players like DYDX and GMX have got users accustomed to their reliability and features over time. Speaking of reliability, we don't know yet how the real-time risk model of Vest would perform in dire conditions. Liquidity is also another point to be wary of. If it goes missing for a longer time, trading slippage and user adoption are bound to suffer. In conclusion, I like that Vest is taking a bold step in the DeFi space, aiming to fix inefficiencies and risks in perpetual trading platforms. With its zkRisk engine, fair pricing, and transparent risk management, it is designed to benefit both traders and liquidity providers. And its focus on capital efficiency and reduced exploitation makes it a compelling alternative. However, execution is everything. Competing with giants like DYDX and GMX won't be easy. Vest needs to prove its model works better. Adoption and regulatory uncertainties remain major hurdles too. At the end of the day, success will hinge on its ability to grow liquidity and deliver superior performance. If Vest delivers on its promises, fairer trading and predictable returns, it could carve out a strong niche in DeFi derivatives. It is ambitious and innovative, but now it needs to prove itself in the real world. Whether it becomes a game changer or it fades in the background, time will tell, and I'll be there to report. Now, if you've watched so far, you totally deserve to learn about Vest's points program. Vest is making moves with its points program, which launched on March 13th, 2025. They're handing out 1 million points weekly for 6 months to reward trading activity and liquidity provision. It's all about incentivizing engagement, boosting liquidity, and giving early adopters a reason to stick around. Liquidity providers can take it up a notch with the Ignite Rewards program. Live since January 6, 2025, it offers boosted yields for supporting Vest's liquidity pool. Even better testers and active Discord participants are getting rewarded, guys. Talk about building community. In my opinion, these programs are a clever way to drive adoption and make Vest stand out in the crowded DeFi space. Okay, airdrop addicts, that was the detailed breakdown of Vest and their airdrop. If you liked the video, then hit the like button and subscribe. I'm Stan, and I expect to see you next time here on the airdrops.com channel, when we'll be dropping some proper alpha on the next exciting Web3 project. And their airdrop potential? Well, let's say it will be a blessing from above. Until then, see ya.